Welcome back to Market Mechanics Decoded, the channel where we break down money, investing, businesses, and the economics behind how wealth is actually built. This visualization shows the classic investor's crossroads. Imagine you have capital ready to deploy, maybe $10,000, maybe $500,000. Parking that money in passive stocks follows the slow, wavy trajectory on the left, but putting that capital into a real, cash-flowing business can completely change the steepness of your returns. There is no guaranteed profitable business. Your location, local competition, financing, and ability to manage employees dictate your results entirely. Money helps you start, but execution creates success. Today, we are running a hard numbers analysis on 20 different business opportunities across America. We'll evaluate their initial capital requirements, their revenue mechanics, and the hidden operational trade-offs you will face over a 1 to 2 year horizon. The most reliable path to monthly cash flow rarely involves finding a glamorous tech startup. Usually, it requires matching your specific available capital to a boring, essential service model. We begin with businesses requiring $10,000 to $40,000 to start. Number 20 is mobile car detailing. You don't need a storefront. You take the service directly to homes and corporate fleets. The strategy here bypasses one-off $100 washes entirely in favor of recurring monthly memberships. This equation shows the power of the model. 150 local subscribers paying a $100 average generates $15,000 in monthly recurring revenue, and that is before selling premium add-ons like ceramic coatings. Number 19 is a commercial cleaning company requiring $10,000 to $50,000. Instead of fighting for individual residential jobs, you secure recurring B2B contracts with medical facilities, offices, and warehouses. This calculation illustrates the commercial scale. Landing just 25 businesses paying $2,000 a month puts you at a $50,000 monthly revenue run rate. You then hire crews and supervisors to handle the daily routes. Number 18 is pressure washing, taking $8,000 to $35,000 to launch. The economics improve dramatically when you pivot away from residential driveways and secure high-margin commercial jobs cleaning shopping centers, apartment roofs, and parking areas. Number 17 is junk removal, requiring a $20,000 to $70,000 investment. The target market isn't a homeowner cleaning out their garage one time. The reliable cash flow comes from building repeat relationships with property managers, real estate agents, and house flippers who need constant clearouts. Number 16 is landscaping, starting around $15,000 to $75,000. You build a dense neighborhood route, then maximize the revenue at each stop by upselling mulching, tree trimming, and winter snow removal to the same existing customers. For these 5 low-barrier models, the initial capital risk is small. The true cost is the immense physical hustle required to build dense local routes and outlast an ocean of new competitors who can easily afford the equipment. Moving to mid-tier trades, number 15 is pest control, requiring $20,000 to $80,000. Strict state licensing requirements for handling chemicals create a natural barrier to entry. This secures highly predictable quarterly and annual recurring revenue from a sticky customer base. Number 14 is pool cleaning, at $15,000 to $60,000. In warmer states, a dense weekly route provides strong base revenue, allowing operators to capture high-margin upsells on pool pumps, filters, and equipment repairs. Number 13 is HVAC, and number 12 is plumbing. Both require $30,000 to well over $150,000. They share a distinct economic advantage: inelastic emergency demand. When a water pipe bursts or an air conditioner completely fails on a 100-degree day, customers cannot delay service. The operational bottlenecks here are severe. You have to navigate expensive insurance premiums and fight a constant battle to recruit and retain specialized, certified technicians in a very tight labor market. If you are finding value in this breakdown of business economics, take a second to hit the like button and subscribe to Market Mechanics Decoded. We have plenty more videos coming on how capital actually moves. While licensed trades offer predictable revenue streams and services like plumbing benefit from emergency-driven demand, an owner's growth is still strictly capped by their ability to recruit and retain specialized labor. Now we enter capital-intensive territory. Number 11 is an express car wash, costing anywhere from $500,000 to several $1 million. Modern car washes survive on high-volume monthly subscriptions rather than individual ticket sales. This chart displays the subscription leverage. Securing 2,000 members at $30 a month yield $60,000 in near-automated monthly revenue before accounting for single washes. The trade-offs are absolute. You are taking on massive commercial debt, paying heavy utility expenses. A single miscalculation on commercial real estate, zoning, or a debt servicing schedule can put the entire operation completely underwater. Number 10 is a laundromat, requiring $150,000 to $750,000. Demand remains steady through economic downturns. Operators offset massive utility bills and equipment financing by adding hybrid services like wash and fold, delivery, and commercial accounts. Number 9 is smart vending, taking $10,000 to $100,000. The machine itself produces zero value on its own. Your profit is dictated entirely by foot traffic, making the acquisition of prime locations inside hospitals, campuses, and factories your only true business. Number 8 is mobile pet grooming, starting at $30,000 to $150,000. You capture a high retention rate from passionate pet owners seeking convenience, but your daily revenue hits a hard ceiling based on the physical capacity of a single groomer working in a van. Number 7 is a childcare center, requiring $75,000 to $300,000. It produces consistent monthly tuition. To keep that revenue, operators must manage extreme regulatory compliance, strict facility safety requirements, and rigid employee-to-child staffing ratios. This demographic chart tracks the massive expansion of the 65 and older age bracket over the next decade. America's aging population is driving intense demand for service models tailored specifically to seniors. Number 6 is senior transportation, and number 5 is non-medical home care, both ranging from $30,000 to $150,000. These capitalize on the desire to age in place, creating high-hour, weekly recurring billing for services like meal prep, companionship, and transit to appointments. The primary hurdle for a home care agency is the relentless cycle of human resources. You must constantly recruit, thoroughly vet, and work to retain reliable caregivers in a high-turnover industry. Number 4 is a healthcare staffing agency, requiring $50,000 to $200,000. You connect nurses and technicians with hospitals and rehab centers. The agency profits strictly from the margin between what the facility pays the agency and the hourly wage the worker receives. While staffing requires little physical infrastructure, operators have to manage payroll financing. You need substantial cash reserves to pay your workers every week, often long before the hospital finally settles its invoice. Now we look at the top 3 opportunities. Number 3 is an AI automation agency, starting as low as $5,000 to $30,000. This is a purely knowledge-based business. You scale by using software to automate customer service, scheduling, and invoice processing for other companies. This visual highlights the margin potential. Acquiring 40 B2B clients paying $1,000 a month translates to $480,000 in annual recurring revenue without investing in real estate or heavy equipment. The critical trade-off for an AI agency is customer acquisition. Convincing skeptical business owners to pay you to overhaul their internal tech stack is a difficult, high-friction sales process. Number 2 is property maintenance, requiring $30,000 to $150,000. You act as a single-call vendor for commercial landlords and apartment complexes. Instead of doing the manual labor yourself, you manage a web of subcontractors to handle painting, repairs, and property turns. And finally, number 1. Instead of starting from zero, use your capital to buy an existing, profitable business from an owner reaching retirement age. Acquisition allows you to bypass the most difficult phase of business, finding your first customers. You purchase an operation with existing cash flow, employees, and equipment, and immediately seek to increase its profitability by updating its outdated systems and marketing. Scaling through acquisition isn't about building a new system from scratch. It's about identifying an inefficient, established operation and optimizing its mechanics to better capture existing market demand. This matrix plots the 20 business models based on initial cash requirements along the bottom versus daily labor complexity on the side. Focus on the zones circled here. This represents models that balance risk by avoiding extreme commercial debt and massive high-turnover workforces. Chasing an industry solely for its high profit margins will fail if the daily operations don't fit your skill set. A well-executed $30,000 pressure washing route will easily outperform a poorly managed $1 million car wash. Use this as a starting point, not financial advice. Before deploying capital, you must research local labor costs, verify customer demand, and calculate your specific break-even point. We want to hear your strategy. If you had $100,000 in daily best today, which of these 20 businesses would you choose to operate? Drop your answer in the comments below. If you found this breakdown useful, please like the video, share it with someone looking to start a business, and subscribe to the channel. Don't just follow the money, understand the mechanics behind it. Thanks for watching, and we'll see you in the next video.